Thank you, Tracy. Good afternoon, everybody. I apologise for you having to look at me if you're eating your lunch or if you just recently finished your lunch, but I've been assured that this is a more effective way of communicating with attendees. Tracy, thank you very much for the introduction. You've got a wonderful telephone voice, and it made me want to reach for my life jacket to make sure I was doing the correct check-in procedures. Today's presentation is around, obviously, the relationship between auditing and fraud, and I've got some notes prepared. There's a PowerPoint presentation, but as Tracy said, if anybody would like to ask any questions, if you type those in, I'll do my best to look down at the screen and make sure that I see those and answer those questions as we go along. If you're having trouble hearing me, this is my first time using a headset. I thought I might look a bit like Madonna, but having a look at myself in the reflection here in my webcam, it's not a pretty sight, so again I apologise. So without any further ado, the reason, I suppose, behind this presentation is around the fact that I've been involved in fraud, risk management investigations for nearly 30 years. Before I start, I'll say things which I think are funny, and if you think they might be funny too, please feel free to laugh, or if you're in a crowded room you don't want to seem embarrassing, at least smile along. But I've been involved in this for nearly 30 years, and I think the one thing that I can honestly say is that despite the focus on cybercrime and hacks and phishing and farming type frauds that start with a PH, that after nearly 30 years, that the types of frauds that we're investigating now, not only here in Australia but around the world, are pretty much the same as we investigated when I first started in the police many, many moons ago. So the purpose of today is to try and share some of my experience that I've gained during the course of my professional career, some tips of the trade that I've learned, discuss perhaps why auditing doesn't identify fraud at an early stage, and also as an opportunity for people to ask questions and learn, obviously not just from me but for their peers who are also involved in this presentation. So I'll just move through to the first slide, and you'll see that there's a question there saying, what do these organisations have in common? So if you think you know the answer to that, please raise your hand. No, that was an attempted humour, so I'm hoping that somebody's at least smiling on my behalf. So what do these organisations have in common? Well, I'm sure people are looking at them and saying, well, you know, a lot of them are failed enterprises or have got some troubles with the court. They've suffered a fair bit of reputation risk as a result of incidents that have happened there. There's, you know, they've involved fraud or allegations at least of fraud or corruption. But if you look at some of these names, you've got everything from HIH Insurance and Clive Peters, you know, small Australian organisations, all the way up to the Enrons, Siemens, and then you've got government sectors such as Note Printing Australia and the Health Services Union. I think what's important to understand is that in each and every one of these organisations, they've suffered a major, and in the case of Enron, catastrophic fraud or corrupt conduct that has severely impacted the organisation. But what's important to remember is that each one of these organisations will have been or is subject to internal audit and external audit. If you look at their code of conduct, they'll be in place. They'll have fantastic policies and processes relating to procurement, relating to disclosure, relating to a variety of what we can see as good corporate governance. Yet, in these examples, and as most of you know, is that there have been some fairly major failings that have resulted in some pretty dire consequences, not only for the organisations, but for directors who have gone to jail, for investors who have lost money, and for market confidence, which has been rocked. And you know, in the case of Enron, you had you know, a very large global accounting firm cease to exist as a result of their role in that. So what I'm going to start off is just a few examples about fraud and corruption on a global scale, so you get a bit of an understanding of the context of where we're coming from. And I used Walmart before as an earlier example. So in 2012, the New York Times published an article about allegations of $24 million US that have been paid in bribes through Walmart's Mexican subsidiary for licenses to expand throughout the country. Now, the basic premise was that Walmart was very, very keen to expand in Mexico and obviously Latin and Central America. And for those of you that have worked overseas and in developing countries and in countries that perhaps don't have the same level of sophistication as other countries, it can be very, very difficult to get things done. And that's purely through inefficiencies, through a lack of frameworks to support decision making, and then sometimes fraud and corruption. So in this instance, obviously, a decision was made by people at the Walmart's Mexican subsidiary to fast-track things by paying bribes. Now, last count, we're talking about over 155 million that had been spent on compliance and dealing with compliances, and I believe the cost all up to Walmart is now closer to $500 million US, because subsequent to this, Walmart conducted their own investigation, and I believe that they've identified discrepancies in other countries, including India. So I suppose the key thing that comes out of this, this particular case study or this particular example, is that organisations, when they're considering or dealing with fraud and corruption, will look at it and say, well, it's not a particular major issue. It's not as important for us as, you know, failing to meet a regulatory requirement or not capturing a market or not protecting our IP. But in these situations, you can understand they can have some very, very serious, not only financial, but also reputational and legal risks. The second one involves US retailer Target, who had 40 million credit and debit card accounts affected by a data breach for about a 3-month period in 2013. Now, as recently as yesterday, Sony announced a major breach of its own systems, and from which they've at least 5 movies that I think have yet to be released have been pirated, as well as account and social security numbers relating to staff. So a number of organisations in recent times have had suffered from serious breaches which have not only compromised the integrity of their data, but in such circumstances such as this, about credit and debit card accounts. So from an audit point of view, I think you'll be finding more emphasis now around protection of data, particularly if any of your customers, or sorry, any of your clients hold credit or debit card information. They're going to be now further ensconced or covered by what's called the PCI DSS, or the Payment Card Industry Data Security Standards. So again, it's another thing that you're looking at when you're building your internal audit programs or external audit programs, and when you're dealing with your clients, that is something that if it's not high on their list, it should be. And I think organisations quite often forget what type of data they are holding there, and it could even be government entities that you're working with, and when they have ratepayers or customers who are paying by way of credit card, and you find out that they're holding all of this credit card information, and quite often it's in hard copy file where somebody's filled out a form or submitted some sort of payment, and they're sitting in an unlocked filing cabinet. So again, this is a great case study because it talks about the value of not only an organisation's internal data, but the external data that it holds from parties such as customers and suppliers, etc. Now, I don't know if anybody's been involved through their clients, if anybody's been involved in a investigation or reviewing data security or data breaches. If there's any anecdote that you want to send through to me that I can share with the other attendees. But it's certainly something that I know should be high on the list of risks for audit and risk committees and certainly the C-suite. Now, there's an organisation, it's run out of the States, but it's now got, I think, close to 60,000 members around the world, and it's called the Association of Certified Fraud Examiners, and I'm sure many of the attendees are well aware of who that organisation is. And the fact that for every 2 years they undertake a global fraud study. The idea being is to get a better picture of how fraud is progressing and how it's impacting organisations around the world. And the latest one was obviously 2014, the figures were released early this year. But when you look at some of the numbers here, again, I think it puts into context the importance of fraud from an audit or from a control point of view. And I know that the accounting standards and principles now, and again, I will put my hand up here to say that I'm not an accountant or an auditor, but I'm aware now that the last few years that fraud has certainly had a a higher focus in terms of needing to consider fraud during an audit, and also exercising professional skepticism when dealing with books and records. But if you look at the first point in here, the typical organisation loses 5% of revenues, which based on the 2013 gross world product was $3.7 trillion. Now I'm sure many of you that are listening to this have clients that if you said to them that, and this is again 5% of revenue, not 5% of profit, that they are losing 5% of their revenue through fraud, the first thing they would say is, that's a lot of money, how could I notice that doesn't go missing? And secondly, they'd say, what can we do to reduce that number? Now, to answer the first part of that question, the reason organisations quite often don't understand what they're losing to fraud is they have poor loss data capture mechanisms. And by that, I'll use the example of the retail industry. And for those of you that have worked in the retail industry or who audit or work with clients in the retail industry, I'm sure you've all heard of the term called stock shrinkage. So stock shrinkage is, we'll basically say that the, our inventory control system says that we should have 10,000 units, and when we've done a stock take, we've actually got 9,000 units. Now the problem, when I've done reviews of organisation supply chains, and the problem you have is that quite often the supply chain has got so many holes in it that you never know whether the 10,000 units were actually received in the first place when they were received from the importer, or from the courier company. Then they get sent out to a warehouse, they get sent out to distribution centres, they then get out to the shop. So there's all along the ways. You never know whether those 10,000 items already hit the shelf. But the main thing to remember is that stock shrinkage is actually is basically theft in many, many examples. Obviously there'll be shrinkage or due to destruction of inventory during transit, etc. But for those of you that work in financial services, I'm sure you've come up against issues where organisations will classify a loss as a credit loss or as a lending loss as opposed to fraud. And I addressed an operational risk conference of bankers a number of years ago, and I asked, and I said, what's the difference between fraud and a loss through a poor lending decision? And somebody who'd obviously been watching CSI or Law and Order said, guilty intent, fraud involves guilty intent. And I said, well, fantastic. I said, but if you're a lender and you lend $100,000 to a person or an organisation and they make no payments, how do you know that they didn't legitimately overextend themselves and couldn't afford it? Or how do you know that they didn't engage in fraud by inflating their assets and deflating their liabilities, etc.? So again, it's very, very hard to prove whether the loss was caused due to poor lending decisions, poor credit underwriting, or whether there was a deliberate fraud. Now the median loss was over $145,000, but it's the third point that's really, in my belief, is the crux of the reason we're here today. The frauds reported lasted a median of 18 months before being detected. So that's 18 months before anybody detected a fraud. So if you think of it from your own audit plans, the fact that you're in an organisation, you've got so many 100 hours allocated to be doing reviews, it would say, well, then how does fraud go undetected for 18 months? Now, I'm well aware of the issues of materiality, and I know the whole principles of sample testing and that. And a little bit later in this presentation, I'll talk about some of the reasons why fraud does go undetected for so long. And again, corruption actually caused a larger loss of $200,000. I think what's interesting to note is that the #1 way that fraud was detected was by tip, so more than tip-off, so more than twice of any other detection method. So again, that's really important, because when we go in and do fraud risk assessments with organisations, we work with them, and quite often they'll say, well, the auditors will pick this up. And we say one or two things. The first thing we say is, well, that's fantastic, but if the fraud has already occurred and it's picked up by the auditors at a later date, or whether it's picked up by an end-of-month reconciliation, the funds or the assets have already left your organisation. So therefore, you're then spending a lot of money to try and get that money back. And as you can see from the last point, 58% of victim organisations had not recovered any of their losses, and only 14% had made a full recovery. And that doesn't take into account the opportunity costs and the legal costs and investigation costs associated with trying to get that money or those assets back. So again, I think that's important to understand and reinforce with your clients that it's, whilst an audit is there to detect those irregularities, it's far better to prevent a fraud than to detect than to investigate at a later stage. I think the second part that comes out of that too is the importance of having some sort of reporting mechanisms. Now, we always work with clients and tell them that they need to have a reporting mechanism where they report to their manager, line manager, or if they're concerned about the line manager once removed. But the ASX corporate governance principles and best practice basically says that organisations should have some form of whistleblower program or some sort of reporting channel where somebody can actually get in contact and report an irregularity within their organisation. And when you consider that if you're a junior auditor, a junior person in accounts payable or accounts receivable, this is your first job out of university, and you come across an irregularity involving somebody who's either your boss or somebody very senior in your organisation, it'd be quite a daunting task to actually make a report about them. So being able to do it anonymously provides a more open channel to pick up information at an earlier rate. What's also important there too is that organisations with hotlines experience frauds were 41% less costly and they detected them 50% more quickly. So if you're working with organisations that say, well, should we have a whistleblower hotline, there's some statistics that you can use to reinforce the importance of them. And I think when people talk about hotlines too, you need to make sure that what they're talking about is not just a telephone in the company secretary's office that nobody answers and nobody rings back for days on end. What's also important for those of you that have clients in the SME is that small organisations tend to suffer disproportionately larger losses due to occupational fraud, and quite often that's because they'll have lack of segregation of duties, or they'll have senior people who commit the fraud and get away with more funds. And on that note, it's worthwhile knowing that the typical fraudster is male, middle-aged, tertiary qualified, and a position of senior employment. And when you look at all of those, quite often that makes up our clients that we're dealing with on a day-to-day basis. I thought I'd throw in a couple of examples, some of the new fraud trends too, and the first two there are intertwined, but what we're finding is that organisations now are trying to beat fraud through what's called two-factor authentication. And I'm sure you've been aware of it if you've got bank where you do a transaction and the next thing you receive either an email or you receive a text saying, "Here, use this number to confirm that it's actually your transaction or a valid transaction." And I think what's important to note is that what the criminals are doing now is the criminals are actually hacking into people's email accounts, so your Gmail account or your Hotmail account, and through that they're then being able to see what, if you've got your credit card information going there because you don't want to go to work, or you've got bills going through there, they can understand who you're banking with, what type of transactions you're undertaking, and they can actually send through emails to your banks and say, here's changing my bank details, changing my address, etc. So again, we're seeing that, and we're also seeing the porting of mobile telephones where they get in and assume your identity, take your mobile number so that when they do a transaction, the authentication goes to them instead of you. Certainly something that we're seeing in China is the increased identification and prosecution of corruption offences. In Australia, I think that we will see more prosecutions and more inquiries by the regulators on the back of the Australian Criminal Code, and obviously by our counterparts in the UK and the US. So I think a lot of that will be an increased focus on trying to gain assets as a recovery of revenue post GFC, and if you follow the papers and understand that they're saying that the resource prices are going to be staying at a deflated rate for a long period of time, governments are going to be looking where they can make up the shortfall, not only here but also obviously elsewhere. So there'll be more focus on your customers, particularly those that are either banking offshore or doing business somewhere outside of Australia. And I would dare say there's probably nobody that you deal with at this stage doesn't have an exposure external to Australia, whether it's through their customers, whether they've got agents selling their services over there, whether their supply chain, they're supplying goods or services or support from overseas. I think that's another trend that we need to be aware as professional advisors to our clients. I've got a couple of case studies that have been in the last couple of years. One related to an insurance company where a husband and wife defrauded the insurance company out of $17 million in 2 years, 430 allegedly fake invoices for legal services. Again, so that's over 2 years. We've got $17 million that went undetected until, as I said, obviously 2 years later. Pardon me. This one here was a very interesting case study. It involved a client in Western Australia receiving an anonymous, Western Australian police receiving an anonymous complaint stating that a staff member had been ripping the company off. The police went to the client came to us. There was no other information other than saying that he'd been ripping them off. It turns out later that the informant was a disgruntled girlfriend who was disgruntled because the fellow hadn't left his wife. So it was a very painful experience for him, because when we did the investigation, we found that the financial loss was in excess of $2 million. And what was interesting about this case was there's a number of things. The first thing is red flags. Now, I've never investigated a matter, and I've investigated literally thousands of matters over the years where there hasn't been some form of red flag. Now, in this instance, the red flag was you had an employee who was living beyond his means. Every year, he and his wife would take an overseas holiday trip around the world, and they do it business class. And what he used to tell management and the staff was that his father had passed away, left him a townhouse in Paddington, which he'd sold, invested the proceeds, and used those proceeds to travel. So you can imagine how surprised his father was when we met him as part of the investigation to learn out that he'd supposedly been dead for about 5 years. The second part about this is the fact that the types of fraud that are occurred, they don't just do one type of fraud. So if somebody, and this is important, that if you come across somebody in your client who is ripping off expenses, you know, they're putting in false expenses or something like that, the chances are they'll be committing fraud in a different way. It could be false overtime, it could be taking leave and not recording leave, they could be colluding with suppliers to inflate invoices. Very rarely do fraudsters engage in only one type of fraud. So in this one here, there was a number of frauds. The first one was the sale of assets written down as damaged. So what he would do is he'd get things like a portable compressor, which might be worth $50,000 or $60,000. He would say that it's been damaged. He would write down the value to $10,000. He'd then sell it to his mate, who would then put it on an auction site and receive anywhere between $30,000 and $40,000 because there was nothing wrong with it. He was also diverting the apprentices' tool allowances using the suspense account. He was getting kickbacks from suppliers. Even as far as when the headquarters went through a revamp, he was given the job of selling furniture to staff at reduced rates, and he did that, did a fantastic job, but just kept all the money. Nobody asked him where the money went. So again, I think that's important, is that when you look at when you come across what's a prospective fraud, we always work on the tip of the iceberg. What you see is not what you get. And I remember coming across one matter where we'd been referred a matter by another Big Four accounting firm. They had a CFO. He confessed to $175,000 fraud. They thought it happened too easy. They were the auditors, so they got us involved. And by the time we finished, it was in excess of $5 million. So again, always be wary of the fact that if you do come across a fraud, it's highly likely that what you've seen is only part of the entire picture, which is why it's also important to make sure you keep what you're doing to those that need to know in case you're speaking to somebody who might be involved in the fraud. So just at this point here, has anybody been involved in investigating a fraud that would like to, you know, if you'd like to send me through a couple of points of what you saw, the different types of fraud you've investigated, I'll share those with the audience as we go along. Now, the reasons why does fraud go undetected so well for at least 18 months, if you believe what the statistics show us. And what's important to understand is that survey by the ACFEs has been ongoing for over 20 years, and those figures don't really change much. The losses always range between 3 to 5%, and the fraud's always in excess of 12 months undetected. So then, I mean, I know you as audit professionals that you're well aware of the limitations that you have in terms of you've got to undergo, you've got an internal audit plan, you're instructed by your clients on how many hours you can allocate. They will tell you what they perceive to be their high-risk areas. There'll be a range of issues which will impact on you from an operational point of view. But in my experience, and I've been very fortunate to work beside some really good internal auditors where we've partnered with them and where we've come in after the fact, is that quite often the offenders are senior employees. So first thing is they know what the control environment is. They know what you're going to look for because they may have signed off the internal audit plan. They may have actually been involved in setting up the internal audit plan. So they'll know that you'll look for, you'll do data mining and you'll be looking for transactions between $8,000 and $10,000 because the approval limit's $10,000. So they'll structure transactions to fall in at $7,750. Or they'll know that you'll be looking at unallocated funds or closed transactions that don't have the corresponding documentation. So they will do everything that they can do to disguise it or to structure the fraud in such a way that it doesn't fall within what you're looking for. And secondly, because they are senior staff, when you send out your internal audit team, and sometimes you'll be using your juniors that come out to obviously pull a lot of the documents, etc. If they're not experienced, firstly, in terms of not from the audit point of view, but more importantly in terms of what their industry is. I mean, that's one of the things we love about professional services is one day we're working with a movie studio, and the next day we're working with a Commonwealth Government department, and the next day we're working with a uranium mine in the middle of the desert. So because that we're experts in audit, we're experts in risk, we're experts in fraud, we might not necessarily be experts in what our clients do. So therefore we rely on them to provide us with information. So particularly when you're dealing with staff who don't understand that and they're asking questions, if they get a question which sounds plausible from a technical point of view, and I'm talking technical not from an audit point of view, but technical from this is how the operation operates, then there's an opportunity there to perhaps be steered away from the real risks. And then the third point there, which is always a contentious point, but which was certainly borne out by Arthur Anderson's, was the professional skepticism versus client management. Now, again, this is not just to deal with auditing, but generally speaking, as human beings, we want to be liked. First thing is we want people to like us. Very, very few people go through world not caring whether they're liked or not, and those that do quite often tend to be what we call corporate psychopaths, or for those of you who have come across those type of people, either bosses or partners at where you work. But for the majority of us, we want people to like us. So the first thing that we do to avoid having people like us is we want to avoid confrontation. So if somebody provides us with a reason that's even closely plausible or likely, we will say, okay, then that makes sense. And we don't necessarily want to challenge them on the assumption to say, oh, well, I'm sure they're telling me the truth, or they know their business better than I do. So again, it's that's human nature, and that's what fraudsters prey on, because you've got to remember that fraudsters are by and large highly sophisticated people. They're good at actually getting people's confidence up, which is the term con artist. That's where that comes from. So therefore, that's one of the reasons why fraud goes undetected for so long as well. So if we're looking at all of these challenges that we have, and we're looking at the fact that we've got the people committing the fraud as senior people know what the auditors are looking for, know what the controls are. We're dealing with the fact that we're dealing with multiple organisations obviously operating in different sectors. How do we actually combat that and make the internal audit more effective in detecting fraud and corrupt behaviour? Now, I'm a firm believer in adopting a risk-based approach to audits, and I'm sure the majority of you do that. But when I talk about a risk-based approach to audit, I come about it from a slightly different way. And I'm sure that when you've spoken to your clients, they'll tell you what their high-risk areas are. But quite often those high-risk areas they've identified as high-risk areas, come in the absence of actually any empirical data or any understanding of what their real fraud risks are. And at this point, I'd like to emphasise the importance of undertaking a fraud risk assessment on an organisation. I fail to see how any organisation can understand what their fraud risk environment is if they haven't undertaken a risk assessment. I mean, we go into organisations where they've got fraud awareness training and fraud profiles which focus on company expense cards. And then when we get in there, we find out that out of a workforce of 5,000 people, 100 people have got corporate expense cards, and that they've got limits of $5,000 each month, and they're completely reconciled. So therefore, if somebody goes off the reservation, they're probably only going to get $5,000 to $10,000 anyway, whereas they don't understand that the static data that's sitting prior to, you know, the payroll information that's sitting prior to going transmission to the bank is actually sitting there as a clear text file and can be altered, and everybody's payroll can actually go to one person's account. So if you're going to work with a client and say that we want to adopt a risk-based approach to the audit, it's very difficult to do that or demonstrate that if you haven't undertaken a risk assessment of your client to understand where their high fraud risk areas are. So once you've identified that, that allows you to identify the high-risk areas for targeting, because really you want to help your clients, and the best way of helping your clients is helping them sometimes help themselves and let them understand what their risks are and how those risks need to be addressed. What it also does, it also allows you to understand the types of fraud that you look for. So an outcome from our fraud risk assessments, when we do it, are quite granular. So rather than saying fraud in procurement, what we would do as an outcome is that a project manager colludes with the supplier to submit an inflated invoice in return for a kickback. So you might say, okay, that's something we're going to look for. How do we look for that? Well, let's do some market testing or benchmarking to say, well, you know, we're paying $5,000 a unit for this product. We've gone out to market, and the average unit cost is $3,500. So why are we paying $5,000? Or look at historical spends and say, well, we used to spend $3,500 for this unit. Now we're paying $5,000. Why those change? Why has that unit cost gone up? So by undertaking a fraud risk assessment and actually identifying the types of frauds at a granular level or a micro level allows you to better design your tests to look for those types of fraud. It also allows you to allocate the resources better depending on the risk rating. And I spoke about earlier that one of your key conflicts, sorry, not conflicts, one of your key constraints is the fact that you only have X amount of hours that you can dedicate to actually identifying fraud. So by understanding of what the higher risk areas are, using their risk appetite, that allows you to get better bang for your buck and for the client's buck. And what it also does is allows you to address management areas of concern. So again, that's the importance behind a risk-based approach to auditing. It's also in terms of control effectiveness. And I've got a case study following this which will give an example of our control effectiveness. But when we deal with organisations, we talk about effective, partially effective, ineffective. And a lot of that comes through distinguishing between a preventative control and a detective control. So going back to what I spoke about earlier is when organisations say, yes, the end of week reconciliation, the end of month reconciliation, or the auditors will pick that up, we will say, well, that's a detective control, and that will detect it after the fact. To be effective, or fully effective, it'll have to be preventative control, which means that it was physically impossible to transfer those funds, steal those assets, submit that false invoice, etc. So that's, again, something to bear in mind when you're looking at control effectiveness. And also in relation to control effectiveness, and I'm sure you've all seen this when you're sitting down with management, the first thing is the key person. We've got Gillian's been in accounts with us for 15 years. She's fantastic. You know, the other day I submitted my credit card expenses and I forgot to put a taxi voucher in there. It was only for $25 and she picked me up about it. You know, nobody could ever get away with anything in there. Well, the first thing is that the first issue you've got there is that's fantastic, but what happens if the key person is the person who's actually committing the fraud? Who's overlooking them? And the second thing is, what happens if that key person moves on? Or if they just happen to go on long-term sick leave, or if they've got problems at home and they're distracted from their job. So, as I said, I think this is something that organisations, particularly small organisations, will quite often rely on as a control, is the fact that Gillian in accounts will pick it up, or that Bob has been in the stores area for 30 years, he notices if a box of nails goes missing. The second key or common mistake is around assumptions, and assumptions are around that something's being done. or not being done. And I'll give you an example. We did work with a large financial services organisation. They had, I'd gone through, done the fraud risk assessment, identified a significant fraud risk in the tens of millions of dollars. I was doing the validation workshop with senior management, and the general manager said, "No, mate, this can't happen, this can't happen." I said, "Well, this is what Bob said." And so next thing, he's on the phone to Bob. "Bob, come up here." Bob comes up here. He said, "Bob, what's this?" He said, "No." He said, "We do this, this, and this." And Bob said, "Well, no." He said, "The practice is that I do when I close intraday accounts, I book it off this, I put it there, and that's it." And he said, "Well, how long has this been going on for?" And he said, 14 years. So this fraud had been sitting there for 14 years. It was only because Bob was honest that it hadn't occurred, but the assumption was that the control mechanisms were different, or that the way the processes were being followed meant that that type of fraud couldn't hurt. This then leads us into the third point, which is changes in processes. So what will happen is that there will be a control in place, and then all of a sudden a new technology will come in, or a new product will be launched, and as a result, that changes the processes, so the controls in place are no longer effective for those new processes. So it's, again, which is why we always recommend that you undertake a risk assessment or fraud and corruption risk assessment whenever there's been major changes. And the last one is the disconnect between front office and back office. And this came from when I was doing work for a bank, where we'd gone through and we did the front office in the lending area, and then we went and did the back office, which was the processing area. And the front office said, "Well, yes, we collect this information, we do this, we do this, we do this, and then we submit the file, and then the shared services team looks at it." And then we went to the shared services, and the shared services team said, "Well, no, all we do is we have a checklist to say they've got to have collected this information, this information, this information. As long as it's there, we tick it off. We don't see if that's if that's a false bank statement or if it's a false credit card. We don't look at that. We just look at the fact that it says they've got to get this information. Yes, they've got it, tick it off." So again, that's where controls and fall down and organisations come into trouble. So what I have, I'm just going to go through a quick case study now, which was involved an organisation, again in the financial services. And so when we look at the control environment, there were segregation duties in places, there were signatures that were on the forms that had to be signed, there was password protection on the computer systems, and there was delegated authorities. So the situation started, I went in, and I'd been working with this financial institution for a while. I went in to conduct this interview, and I walk into the interview. The fellow sitting back at this, if you can see, arms crossed, quite defensive, and he said, "Guy, I understand you're here to do a job, but mate," he said, "listen," he said, "this is ridiculous." He said, "The external auditors have been through, the internal auditors have been through, op risk have been through, the compliance team's looked at me, I've done a controlled self-assessment, I am squeaky clean, there's nothing here." And I said, "Mate, fantastic, this is going to be a very quick interview, what do you do?" So his area is responsible for looking at client complaints. So if you looked at your bank statement and you said, or your statement, you look and say, "Well, there's $50 that's gone out, why is that money gone out?" You go through to his team, you get allocated up to one of his investigations officers, they go through and say, "Yes, it's an incorrect debit." He said in that situation they would sign off, go to their manager for second sign off, and come up to me for a third sign off up to $250,000. He said, "So we've got segregation duties and delegated authorities." I said, "Fantastic." So what happens then? He said, "Well, we can't even send the money back, we do it by cheque, and we have to do a cheque requisition." Again goes through to 3 levels for checking. We then hand it to the cheque reduction team. And I said, "Well, that's fantastic." And I said at this stage, I said, "So I take it the cheque reduction team has a signature card with all of your signatures on it?" And at this stage, there's a pregnant pause. He's gone from looking, slightly defensive to extremely uncomfortable. And he said, "No, there's not." So I said, "So what are they signing off?" I said, "They're signing off on 3 signatures, not the 3 correct signatures." And he said, "Yes, I suppose you could say that." I said, so at this stage I was on a roll, and I said, "You could sign off Mickey Mouse, Pluto, Pop and Donald Duck, and as long as there's 3 signatures there, they'd sign off." He goes, "Yes, mate, I know what you're getting at." At that stage, because he was a client, I didn't want to gloat any further. But what was important was that it had actually been signed off operational risk, internal auditors and the external auditors, because nobody had thought to ask the question is, well, if this cheque reduction team is actually signing off, do they have copies of the signatures that they're signing against, and or that they're authorising against? And in this situation, they didn't. And I'm sure you've come across organisations that are the same. And And another quick case study was dealing with a CFO, and we talked about the example where somebody could get in and change the accounts payable run every month. And the CFO said to me, she said, Guy, that can't happen because the banks will only pay if the account name matches the BSB account number. And I'm sure most of you now are shaking your head saying, no, that's not true. And in this situation, I said, well, are you sure? She said, no, I'm sure. And again, I'm balancing that difficult thing about telling a client they're wrong. I said, well, are you really sure? She said, well, listen, I'll go call the bank. Anyway, she came back in 10 minutes later. She said, well, Guy, you're right. I said, yeah, it is. So the banks, as long as a BSB account number, a valid BSB account numbers, that's what the banks pay against. They don't look at who the payee details are, or the account holder's details are. They don't have that type of program. So again, that was a control they thought was in place, which nobody's actually taken into consideration. Now, I'd love to be able to say to you that there's some fantastic new, really cool types of frauds that are happening, and this is what you should be looking at, and this is what you should be instructing your junior auditors to look at. But again, if you ask me where the high-risk areas for fraud are, it's the same. It's funds in and it's funds out. Procurement will always be a high-risk area because a lot of organisations now are what they call decentralising, where they're putting the procurement out to their operations, and then you've got people out there that are making decisions, and they've got little oversight. They've got discretion up to $2,000, $5,000. The key thing that we're seeing now is where there might be $20,000, they've got to go out to market. Under $20,000, they can just get some quotes. So what they'll do is they'll get a client, they'll get a collude with a supplier, get a mate as a supplier, get them on, they'll bill $18,000, but they'll do that every month. And so when you sit back at the end of the financial year, they've actually billed over $200,000, which actually should have been a formal request for tender. Payroll is another high-risk area. The Clive Peters case that I used as an example earlier, she was in the payroll area, and she got over $16 million out. Accounts payable and receivable, again, it's the false invoices, it's the changing vendors' bank account details. Again, I can't emphasise enough the importance of having a strong control environment around static data. And it's even like we work with organisations to say that if you do get changed to bank account details or any type of details from a customer or from a vendor, anybody, just have some sort of follow-up process, whether it's follow-up with an email or follow-up with a phone call, just to say, hey, just received your change in bank account details, is that correct? Other high-risk areas, any function which has a sales component, so whether it's commission. You can imagine if you're a salesperson, you're on a quarterly commission, you're 98% of the way there to get commission. The deal hasn't quite got across the line to help you get commission. There will always be a temptation to fudge the figures to get over that, the idea being where it'll land next month. But then, of course, next month you get behind. So, again, we always emphasise areas where it's a commission component. And we've certainly seen many instances where commissions and sales have been inflated to get commissions. And the last one there is on remote locations. I mean, we're all very well aware of the span of control, and the further that span of control gets stretched, and the more autonomy organisations or operations have to operate in, less management oversight there is, the higher the risks are that fraud can go undetected. So some of the red flags, and again, I'm sure that I'm not teaching you much new here, but it's certainly things that we've seen when we go with clients, and I spoke about red flags. When all of a sudden there's a decrease in their margins, and they can't work out why. Our sales levels are still the same, but we've got increase in our cost of goods sold, or why we're heavily discounting our prices. So anything there from the dollar, and that's quite interesting too, is that we know statistically that there's high levels of fraud during tough economic conditions, and I think there's two reasons for that. A lot of people think, well, it's because tough times people engage in fraud. my belief is that it's actually that during tough time, it's when our clients become more focused on their bottom line. So the first thing they start looking at is, well, where can I shave costs? You know, if my sales are down 20%, where can I shave costs? And all of a sudden they start looking at their cleaning costs, the cost of buying new equipment, etc. like that, and they look at it and say, well, actually, hang on for a second, why am I paying $100,000 a year for cleaning costs when last year I was paying $80,000? Why have they gone up? So that's when there's an increased focus on costs, which is why fraud, which is when fraud comes and gets detected. Unexplained decrease in revenue. Again, it's when sales levels, say you're still putting out 10,000 units per quarter, but whereas before you were getting $5 million, you're now only getting $4.5 million. So again, looking at false sales, looking at heavy discounts to related parties, and then a blowout in debtor terms. So where you're, normally people that are supplying, that are paying you within 35 days, all of a sudden are paying you in 60 days. So those are some of the red flags that we've seen. In relation to staff, that's quite interesting, because if you ask somebody who's a manager or a business owner, what to you is an ideal staff member, 9 times out of 10 what they'll say is, well, it's somebody who comes in early, leaves late, will work on weekends, will work with little supervision, never wants to take holidays. That's a perfect employee. And what we will say is, well, chances are that person's committing fraud. And the reason we say that is, if you're committing fraud, normally what you're doing is you're submitting a false invoice, so you're then putting together a false purchase order, you're taking funds from one account, and you've got to balance it up with funds against another account. So it's like juggling multiple balls in the air. So when you're juggling those balls in the air, if you're not there to juggle them, they'll fall to the ground. Which is why it's amazing the number of times that fraud will get detected when Sue can't come into work because one of the kids is sick and she can't get a babysitter, or Bill suddenly ends up with appendicitis and can't come into work, and somebody sits down at Bill's desk, opens up a drawer, and there's a whole pile of unpaid invoices, yet when you look at the accounts payment system, it shows they've all been paid. So what we say is that if you're speaking with your clients and telling them what to look out for staff who don't take holidays, those that are resistant to change or oversight. Like there might be, we know that people are resistant to change and people don't like change, but those that are consistently saying, no, I don't want to change, this works well, I've always done it this way, I've always done it with this supplier, I've always, they give me good service, we say those are a red flag. Failure to supply supporting documentation, and I'm sure you've got clients where you've gone in and say, listen, I need to do some sample audit of these purchase orders or these invoices or these project costings, and I'll get them to you, or no, they've been filed off site. So that type of lack of supporting documentation, and obviously unusual or close relationships with staff and suppliers, vendors or contractors. And on this, and it's a personal bugbear of mine, and I'm sure you've probably seen it professionally too, is organisations that use panels. So you'll see that they say from a probity point of view that you should have a panel of providers and then use those panel of providers. And I sit on it, my firm sits on a number of panels here in Australia and overseas. And what you'll always see is when they go out for an RFP or an RFQ or an RFT is they'll say that being on the panel is no guarantee that you'll get work. So we'll all do it anyway, but then we'll sit back at the end of 3 years and say we never got a job for being on that panel. So what we say is, from an audit point of view, was have a look to see who's being used on that panel, because if you've got a procurement team that's got a panel of providers, of suppliers, and 98% of the work is going to one supplier, I would say that there's a highly likely risk that there's some sort of fraud, collusion or corruption going in that. So very firstly is you understand why that volume of work's going there. Now, I'm sure the excuses you'll hear is to say, oh, we've been working with SPD for 20 years, they know us, we know them, they've always got stuff in stock, that's why we're dealing with it. Now, if everybody's good enough to be on that panel, you would assume that they're all good enough to do the same job. And the problem you've got is if your clients aren't using the panel providers, next time they go out, the panel providers will say, well, bugger that, we're not going to go on it because we didn't get any work, it's all too hard putting together a proposal. So therefore, you lose that whole probity process. So again, if you're looking at it from a testing point of view and you know that they're supposed to be using a panel of providers or contractors, I would focus on those that seem to have a disproportionately high usage as opposed to the others. Which leads us into our conclusion, and then I'll have 5 minutes for any questions that you might have if you have been saving anything up. As I said earlier, I'd love to be able to say that there's some wonderful high-tech frauds that are occurring, and that you need to invest in all of these really cool tools and apps to be able to combat these types of frauds. But in all honesty, 9.5 times out of 10, the frauds that we investigate or we come across are the same old ones. It's false invoices, collusion, inflated invoices, theft of assets, false expenses, false overtime, all those types of things which no doubt you look at as part of your internal audit program anyway. I've spoken the fact that audit programs should be risk-based, and if you can't get your clients to undertake fraud risk assessments, they don't want to spend the money, just sit down and speak to them, find out if they've done controlled self-assessments, find out what's happened in the past, have they had frauds that have occurred in the past, if they've occurred in the past, understand how they occurred, and also find out did the processes change. If the process that was in place when the fraud occurred is still the same process, well then in terms of likelihood you can say, well, it's almost certain it'll occur again because you've got the same control environment. I think it's very important before you do go out on audit engagements, particularly if you're dealing with clients from a sector that you're not familiar with, that the audit teams are briefed on the common types of frauds experienced by those types of organisations. And you've all got a fantastic network of peers. You've got obviously Institute of Internal Auditors. There's a lot of information you get out there and say, oh, well, listen, we're just about to work with a fast-moving consumer goods company, who's worked with them before, and what are the high-risk areas you should be looking at, and what types of frauds have you come across. And lastly, if in doubt, ask someone. So again, using that same sort of approach, that if there is something you're unsure of, there's wonderful pools of knowledge out there internally or externally, and if you're a junior person, part of an audit team, certainly speak up and ask somebody, because I know, obviously as an employer myself, you'd much rather somebody come to you with a question than to proceed on an incorrect assumption and something goes wrong at a later date. Now that takes us into the question period. According to my clock, we have 4 minutes to go. Tracy, I have not seen anything on the panel down here if anybody has any questions.
There was one there, Guy, that you may have missed. It was from Elizabeth. No, I apologise. I've lost it now too. There was one there.
So, do you have one? No?
If the majority of fraud is detected by tip-offs, should we not also extend our review of the whistleblower policy and procedures?
Yes, that's a great question, Elizabeth, definitely. And I think what's really important is looking, one is, do they have a whistleblower policy in place? Secondly, is that policy enforced? Thirdly, how do they protect people that make the disclosures? What do they do in terms of sanctions against those? But the funny thing is where a lot of them fall down is, how is that policy promulgated across the organisation? I mean, we've been providing whistleblower hotlines for this one client for about 5 years, and we also do their bullying and harassment investigations. And when my guys go out there and do an investigation, one of the questions they say is, did you use a whistleblower hotline? And a number of times they say, well, what whistleblower hotline? So when we work with organisations, they say, well, yeah, we've got a whistleblower hotline, it's a waste of money, we've received 2 phone calls in 10 years. The first question we ask is, well, how do you communicate that across? How often do you deliver training on it? Do you send it as a pop-up when people log in the morning? Is it sitting in meal rooms? So Elizabeth, if you're working with organisations, definitely review their policies and procedures in relation to whistleblower hotlines, but make sure you find out, how do they communicate that across the organisation? When was the last time it was updated? When was the last time it was delivered to training? I mean, it should be part of induction training, isn't it? So that's what's really important, and that's the same with any policy, whether it's a code of conduct, a procurement policy, fraud policy. They're no good sitting on an intranet if nobody knows they're actually on the intranet.
Thanks, Guy. And I think Laura agrees with you as well. As posted a reply there to Elizabeth's question that they should be testing the hotline by calling it and seeing if anyone answers and things like that. Folks, if you do have any last-minute questions, please pop a yes into the chat box at this time, just so that we know that there's some more questions coming and we will hang around for you. Whilst you all do that, I'd like to thank Guy for a wonderfully informative presentation. It's fantastic stuff. Folks, thanks also to all of you for coming along today and being part of the process, and especially for your interaction today. It's great to see the questions coming through the chat box, and lots of thanks coming through for you there, Guy, from the attendees as well. No yeses coming through, so we'll assume there's no more questions coming through, so it just remains to me to thank...
Sorry, Tracy.
Yep, go ahead, Guy.
Before you hang up, I'm seeing a couple there. There's one which came through from Adam, which was around that he'd...
Was that sent privately to you by any chance?
It may have been. No, it's still... Was it? No, it's all participants. So...
please feel free.
Yeah, so saying that similar case study one, there's an employed and outsourced provider inflating claims for putting through fake invoices, and it totaled over $2 million. So I think that that's great that, well, it's not great that it happened, but the fact that people have actually seen this means that obviously we're on the right path. And I think Elizabeth also talks about the fact that whistleblowers are very difficult to do when you're in a small country town, and it doesn't even have to be a small country town. It can just be a small organisation. I think the other thing that came up too was there was a lot of input in relation to the changing of static data, and master data file changes are regularly monitored, etc. So there was some very good input into there, and I'm sorry that they didn't all come up on my screen, but certainly, I mean, Tracy's got all my contact details, and I'm happy if anybody offline wants to get in contact with me and ask any questions to please feel free. But thank you very much, and if I don't speak to you, have a Merry Christmas, everybody.
Thanks, Guy. Did you want to just address Warren's comment that he just sent through there at the last possible moment?
Okay, yes, so speaking about controls, our software system has a control that gives a warning message when sales data and deposit data don't match. When we discovered the fraud, we noticed it had been occurring for a number of days and wondered why the control was not working. The warning message was appearing on screen, however the data entry operator realised they just needed to press enter and it disappeared. It saved them time rather than reporting to the supervisor. Well, Warren, that exact scenario is what happened with the SO explosion down in Victoria a number of years ago, where the gas pipeline exploded and killed a number of people. When they went back and did the cause analysis, they found out that there had been a number of signals, and the staff got sick and tired of them going off. They actually switched them off. So they were signals to say that that there was dangerous pressure. And as I said, I don't think yet I've ever seen a fraud where there has not been red flags in some way. So again, from an audit point of view, I think what's really important is that you ensure that your clients are undertaking fraud awareness training, and make sure they tell staff to speak up, because if there's a poor culture where staff don't speak up because they're afraid of getting in trouble, then fraud's going to occur.
Well, thanks very much, Guy. Okay, folks, we are very conscious of the time, so we will finish up now. I'd just like to thank you all once again for coming along, and to Guy for presenting today. Now, as you do log out of the session today, you will be taken to the feedback form. We'd love it if you'd take the 30 seconds required to fill that feedback form in. Your feedback is very important to us here at CPD Live, and also the Institute of Internal Auditors. And I've no doubt Guy would love to see your feedback as well. So thanks, folks, once again for coming along today, and we hope to welcome you online for another live session very, very soon. Until then, folks, look after yourselves, and goodbye for now.